Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm Jill Malandrino, and joining us for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial, and Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss if the Fed is behind the curve on rate cuts and what the impacts of the yen carry trade are. It is great to see the both of you. Welcome back to Trade Talks. And Steve Wyett, it really is a different picture in the markets than it was just 4 weeks ago when we met. There's just been a number of events on the horizon. We saw that volatility pop at the beginning of last week as a result of the yen carry trade. We don't typically talk about the yen as much in these types of shows. Why is the US market so predisposed to what's happening with the Japanese yen?
So, Jill, hey, good afternoon. Great to see you. And Steve, great to see you as well. Look, I think the big thing that happened there is the trade just got so big, Jill. There were so many people that were, as we came through the pandemic, of course, most of the developed countries were raising interest rates. Inflation was moving higher. Japan was the outlier there. They kept interest rates very low. Their economy's been mired in recession, ongoing kind of rolling recessions for what now, Steve? Something like 30 years. And so they just were keeping interest rates very low. That opened the door to the possibility of a high risk type of strategy of borrowing money in yen, very low rates, taking that and investing that in markets around the world at higher yields like Mexico, where you could get a 10% rate of return. And in addition to that, you had the currency working for you. So I think that trade on its face there returned like 40% last year. Well, that works great until Japan finally has to start raising interest rates. The currency markets adjust. Your cost of borrowing goes up. All of a sudden, that trade isn't nearly as profitable. And you've just had so many people doing it that as they ran for the door, it just made for a rather chaotic exit. And that ended up spilling over into the capital markets.
Yeah. And Steve Sosnick, there's that word again, FOMO, but I want to talk about the volatility trade for a moment here. There was that narrative out there that it was the third largest fall pop that we've seen behind the housing crisis, COVID, but it seemed like it was a little bit of a henny penny moment, because if you look at the spot VIX relative to the futures, it was telling a little bit of a different story. Meanwhile, fundamentals weren't that significantly different.
No, and that's what kind of dismayed me a lot, Jill, when you had the immediate calls, oh, we must be in a recession, we got to cut rates imminently, immediately.
Yeah.
And some of them from voices I respect. One of whom literally taught me finance. And the problems to some extent, there were two things. First of all, I think the calls for immediate Fed relief were very US centric. I think people tend to think that if there's a problem in the US, it must be caused by something in the US, unless it's something major geopolitical. But this was sort of much more subtle. Secondly, you had a secondary effect on top of it, besides what Steve Wyett mentioned, in terms of the ever-growing carry trade, because the Bank of Japan was cutting and keep cutting rates or keeping them stable as the rest of the world was raising them. So not only was that trade working out for you in terms of being low interest, it was working out for you in terms of the fact that the yen went from about 110 to 160 in a straight line. So it turbocharged your returns. Over the last few weeks, I'd actually charted this. The yen and NQ futures were moving almost in lockstep, pretty much until Monday. Which tells me that was a big portion. That's where a lot of the money went, was into the high momentum shares that drive NDX, the Mag 7, if you will. But also, you had a lot of people. What that was causing an effect as well was it was making dispersion and very high and correlation very low. There were certain measures where you had basically 7 stocks moving in one direction, and forget 493. It was 7 versus 43, even when you did the correlation among the top 50 stocks. So when you're looking at an index level, that suppresses index volatility. If, I'm going to do a little visual. If you got these going up and these going down, the index washes out. And so what you had a lot of people doing as well was saying, all right, I'm going to short index volatility and I'm going to buy single stock volatility. VIX being sort of the most obvious way to short volatility. And so I think you had as the yen carry trade imploded and people needed to get protection, and you saw volatility measures increase. That then led to a whole secondary layer of I'm going to call it margin calls for lack of a better word, from volatility trades that had been working extraordinarily well, blowing up at the exact same time. And so, yes, this move was exceeded by COVID, which really was a global crisis, and I don't have to relay that. But the other time that it surpassed was Volmageddon of 2018, which this reminded me of, where you had, again, a very crowded short volatility trade. And as Steve mentioned, these trades work until they don't. And when they don't, they fail spectacularly, unfortunately.
Yeah, but that's the short vol trade in virtually any kind of product, Steve Sosnick, right? What's the expression? Picking up nickels in front of a bulldozer, I believe the expression is. But
pennies
Steve
on
Wyett,
pennies on railroad tracks, whatever you want to call it there.
Right. What is it? Escalator up, elevator down. Anyway, those adages apply. But Steve Sosnick makes a great point. If we were to get that emergency rate cut, because the Fed's listening to the market narrative, and it's two different things, the economy and the market, to me, that would have been the surprise vol moment that suggests that, that there is stress in the economy. I'd rather not have an emergency rate cut than have one.
I'm going to add to Steve Sosnick's comments. I was dismayed at the calls for emergency rate cuts and the idea that at the worst levels of the S&P on Monday, stocks were still up on the year. I mean, it wasn't, I was just like, where's the emergency here? And look, I get it, the idea that there were a few economists saying that the Fed should have begun to lower interest rates at that late July meeting. And then the economic data on manufacturing, and then employment comes out a little weaker than anticipated. You kind of say, okay, maybe they're a little bit behind. I've just looked at that and said, well, that certainly strengthens their resolve for beginning to move in September. But this idea that, and I think it was Dr. Siegel, wasn't, that was on CNBC on Tuesday morning calling for 150 basis points of emergency rate cuts. Jill, to your point, had we seen that, the reaction, I think, from most of the market would have been, then now we have a problem. What do we not know? Because what we knew at that point certainly didn't qualify for the idea that the Fed needed to do some type of emergency action. And if they had fallen prey to that, to the market's emotional reaction at that point, that would have been the danger signal on our part. So give the Fed credit. Look, we're not in a crisis. As the week went on, that certainly played out. Monday was the worst day in 2 years. Thursday was the best day in 2 years. We continued this kind of cluster of best and worst days that are somewhat close together. But by the end of the week, the S&P was down 40 basis points. And so if you had taken a vacation last week and really disconnected, you come in today, you go, oh, look at the S&P. It was only down 40 basis points. It was a really quiet week last week. There was a lot of things that happened in between there, but I just, our sense is that the fundamental picture of what the economy is doing, is it slowing down? Yes. Is the employment market becoming more balanced? Probably risk skewed towards unemployment continuing to move up a little bit? Yes. But does that require some sort of emergency action out of the Fed? No. The Fed's patience for easing should be wearing thin, but no emergency.
Well, Steve Sosnick, in a way, it almost felt like the pressure was released. Everyone, was talking about the level of valuations out there, how only a certain number of stocks have been moving, how, trying to predict what the Fed's going to do. We haven't had one of these big moves in quite some time. In a way, finally got that out, right? It's almost like a pressure valve was released, and you kind of had a moment to sit back and, revalue your own sense of fundamentals and technicals and so forth. It was like a reset in a way in my mind.
Some extent, yeah. I mean, you did clear the deck of a lot of leverage trades, of a lot of risky trades. In some cases, some ill-advised trades. I've never really quite understood the point of shorting volatility, shorting VIX, let's say, when it's 13, 14. What are you hoping to gain versus what your potential loss is? And on the other hand, I think one of the things that the market was relieved about, to Steve Wyatt's point, was that that the Fed didn't blink, that they just kind of held the course. NDX had its 10% correction, just barely. If you blink and you might have missed it. The yield curve disinverted for like the time it took me to basically to take a screenshot of it. I happened to be looking at it at that moment and caught it. These were very temporary dislocations. Now, could this metastasize into something bigger? Maybe, because we really don't know how big the carry trade is. We really don't know the extent. It's the Warren Buffett statement of you don't know who's swimming naked until the tide goes out. And the tide went out in a hurry. But I think in general, yeah, it was a necessary reset. And I think we may have reset a little too much. I think Steve Wyett, correct me, but you've been at this for a long time too. Do you ever remember the market having a big move on the back of weekly jobless claims?
Yeah.
No, I can't. Correct me if
I
I'm
mean,
wrong.
I'll go back, Steve, when I got started in the business, and money supply was the biggest number that came out on Thursday afternoons. We'd have some pretty big volatility on those days, but yeah, something like weekly jobless claims normally are not triggering that type of a market reaction.
Exactly. So that tells me that there was still this tells me that FOMO is still there, demand is still there. People are conditioned to buy dips. But I think, by the way, if the Fed is looking to reset their rate expectations, Chairman Powell has every opportunity to do so next week at the Jackson Hole conference.
Correct.
If he wants to say 25 basis points is the number, which he led us to believe at the last press conference, by all means, go ahead. If he wants to tell us it's looking like 50 basis points, despite what Governor Bowman said over the weekend, which she sees 0, let her reset it. I mean, there's plenty of different ways to do it. There's still a lot of flux in the economy. And bear in mind, the market has been ahead of the Fed for the entire year. And it hasn't really hurt the stock market all too much, despite the fact that the Fed hasn't delivered what the stock market has expected or wanted.
Right. I guess, Steve Wyett, that's a question. Are they taking too long to reset? Initially it was, are they taking too long in terms of cutting rates? And now is it raising rates or becoming more hawkish with their policy? I guess you just have to question the market's patience. But then again, the Fed's mandate is not the market.
Yes, the Fed's not here to keep the S&P from trading down. That's what was kind of interesting in the way the things were reacting. Look, Jill, it's true that the economic growth appears to be slowing. The labor market's getting more balanced. The risks to a Fed policy mistake are higher as growth is slower. So we do find ourselves on the side that thinking that the Fed needs to begin to recalibrate their interest rate policy. They do not want to remain overly restrictive. You can't ignore the fact, Jill, that the increase in the unemployment rate on that last Friday did trigger the SOM rule. That's been something that has been pretty consistent at showing when the economy's sliding into a recession. Now, we can add that maybe to the long list of the inverted yield curve and negative M2 growth and tighter loan lending standards and negative readings on consumer sentiment that have been really good indicators of recessions in the past that have just not come to fruition. This post-pandemic environment just continues to be very difficult, but we do think that the risks are elevated a little bit. So to Steve's point earlier about just looking at how trades that have asymmetric risk to the downside versus the upside, I'd put the Fed's risk of staying tight for too long at this point a little asymmetric to the downside. They need to start to recalibrate monetary policy. They don't want to ease and spur a whole lot of economic activity because that does risk a rebound in inflation. But they probably do need to recalibrate with rates a little bit lower at this point.
All right. I appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.